It feels safe, doesn't it? The money sitting in your bank account, a number you can check every day that doesn't go down unless you spend it. This feeling of security is powerful, it's tangible. You earned it, you saved it. Now you are protecting it from the wild, unpredictable world of the stock market. The market, after all, is a place of chaos. Plunge, crash, crisis. Why would anyone risk their hard-earned money in a casino like that? The decision to stay away, to keep your wealth in cash, feels like the most responsible choice you can make. It's rooted in the very human desire to avoid loss and protect what is ours. The problem is that this feeling of safety is an illusion, a dangerous one that quietly erodes your wealth over time. What you don't see is the invisible force of inflation, the slow but relentless rise in the cost of everything. Coffee, $3 today, coffee, $4 in a few years, coffee, $5 later. Your cash, while holding its dollar amount, is losing its ability to buy things. If you look at the stock market on any given day, it can seem like a random, terrifying mess. News channels flash red and green arrows. Experts offer confident predictions that are often wrong. It's easy to see this daily noise and conclude that investing is nothing more than gambling. But if you zoom out, way out, a completely different picture emerges. Over the last 100 years, the stock market shows relentless upward growth. This period includes the Great Depression, World War II, the dot-com bust, the 2008 financial crisis, and a global pandemic. Through all of it, the market has recovered and marched to new highs. Historical data is the most powerful antidote to fear. Think of it this way, on a long road trip across the country, you'll hit traffic jams, detours, and bad weather. They slow you down in the moment, but they don't change your destination. Over long periods, the market has returned far more than inflation, bonds, or cash. This is a historical fact backed by a century of evidence. Market returns don't arrive as a smooth, predictable line. They come in fits and starts, with periods of incredible growth often followed by sharp, painful declines. We are wired to react to immediate threats. A falling stock market feels like a lion chasing us. The slow, creeping threat of inflation feels more like a change in the climate. Easy to ignore now, devastating over a lifetime. So we cling to what feels certain. The certainty of a checking account balance feels more real than the uncertain potential of future market growth. Yet in finance, what is comfortable is rarely profitable. Avoiding short-term volatility means avoiding stock's greatest feature, long-run growth. The price of admission for this growth is dealing with uncertainty and occasional downturns. By refusing to pay that price, you choose to sit outside the theater, missing the entire show. The hidden cost of not investing is the future you fail to build. Data favors the optimist. It shows human ingenuity, innovation, and the desire for progress tend to win out over time. By not investing, you are making a bet against this long-term trend of human progress. Pessimism often sounds smarter than optimism. The doom predictor seems cautious and intelligent. The optimist can seem naive. A little pessimism helps in daily life. But in investing, chronic pessimism is a lifelong tax. It's a self-imposed fee that leaves you poorer. Pessimism makes you overestimate risk and miss out on compounding growth. Consider two investors with the same start. Investor A, optimist, stays invested through ups and downs. Investor B, pessimist, sells when the news gets scary. They hope to re-enter when things calm. More often than not, they sell near the bottom and miss the rebound. Over decades, the optimist's wealth multiplies. That gap is the pessimism tax. Compounding equals earning returns on your returns. It begins slowly, then snowballs into something massive. Compounding needs one thing: uninterrupted time. Each time you pull out, you reset the clock. The optimist keeps the snowball rolling. Durability, not brilliance, is the edge. Our perception of risk isn't formed in a vacuum. It's shaped by two powerful forces: the constant drumbeat of the financial media, our own personal experiences with money. The media's business model isn't to make you a better investor, it's to capture your attention. Nothing captures attention like fear, panic. Dramatic headlines about market turmoil get more clicks. Calm headlines about slightly up markets get ignored. That creates a stream of negativity, making investing seem more dangerous than it is. The noise machine amplifies every downturn. It ignores the long, quiet periods of growth. If you watch the news every day, you're on a diet of financial junk food. It fills you with anxiety. It gives you a false sense of urgency. That's the enemy of good investing. Successful long-term investing should be boring. It should feel like watching paint dry. But the media turns it into a high-stakes sport. Every day feels like the championship game. That pressure makes people act emotionally. They sell everything during a panic, which is almost always the worst thing to do. The media makes long-term investors behave like day traders, even when their goals are 30 years away. Beyond the media, personal histories leave deep, often invisible scars. First investment during a major crash. Seeing your parents lose money. Those experiences can shape your financial worldview for life. You may understand the long-term data, but the emotional scar makes you flinch when markets wobble. Personal experience feels more real than a century of data. We are not spreadsheets, we are story-driven creatures. The stories we tell about money are incredibly powerful. Two people with the same information can reach very different conclusions. Someone who grew up in a bull market sees endless opportunity. Someone who came of age in a recession sees potential ruin. Neither view is complete, but both feel true. Recognizing your limited, unique perspective is the first step to making more rational, less emotional decisions about your financial future. So, how do you navigate this world of fear, noise, emotional biases to become a successful long-term investor? The solution isn't to become a financial genius or to find a secret formula, it's to build a system that protects you from your own worst instincts. The first and most powerful step is automation. Set up automatic contributions from your paycheck into a simple, diversified investment like a low-cost index fund. This pay-yourself-first strategy puts your investment plan on autopilot. It forces you to invest consistently, whether the market is up or down, without requiring any emotional energy or willpower. Automation is the single best defense against fear and greed. The second step is to simply check your investments less often. If you have a 30-year time horizon for retirement, the market's performance this week, this month, or even this year is mostly irrelevant noise. Looking at your portfolio every day is like weighing yourself every hour while on a diet. The small fluctuations will drive you crazy and tempt you to abandon your plan. Check in once or twice a year to make sure your strategy is on track, but otherwise, let it be. Your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Benign neglect is a surprisingly effective investment strategy. Third, commit to a little bit of learning. You don't need a PhD in finance, but reading a few good books on the psychology of money and the basics of long-term investing can fundamentally change your perspective. Understanding why markets behave the way they do, and more importantly, why you react the way you do, gives you the context to remain calm during periods of turmoil. Education turns fear of the unknown into an understanding of the expected. It helps you see market crashes not as a sign that the system is broken, but as a normal and predictable part of the process. Finally, if you still feel lost, consider finding a good financial advisor who acts as a behavioral coach more than a stock picker. A great advisor's primary job is not to find the hot new investment, but to build a sensible plan and help you stick to it when you are tempted to do otherwise. Ultimately, the path to building wealth is not complicated. It's a simple formula. Own a diversified portfolio of assets, be patient, and let the power of compounding do its work over decades. History has overwhelmingly rewarded the optimists who stayed the course. The biggest risk is not being one of them.